And stocks have been flirting with record highs today after the latest earnings results impressed investors. Apple surpassing $4 trillion in market value for the first time, becoming the third major tech company to achieve this milestone. So the question, of course, everybody is asking, can the bull run continue and how far can it go if it does? Let's bring in Paul Christopher, head of global investment strategy at Wells Fargo Investment Institute. And Paul, thanks very much for joining us.
Sure.
We're over 6,800. We're in the S&P. We're over 6,800. Things are looking good. And where do you feel we're heading right now?
Well, I'd be a fool to predict anything but higher. But there are obviously always things that could trip expectations. So we've got the presidents of the U.S. and China meeting overseas to hammer out a trade deal. We're expecting good things. But there's room for disappointment. There's room for disappointment, in terms of the economy slowing down. By how much? Consumer sentiment came out weak today. My point is, look, there's going to be headlines that are going to look maybe a little menacing, or maybe even just a little bit kind of making you wonder about where things are going. And we think investors generally need to look through those headlines and to focus on this trend that is really heading upwards. But that doesn't mean you want to just pay every price being asked. There's probably a cheaper way, we think, to go about playing this trend, and happy to talk some more about that.
Okay, well, and this trend, you're thinking we could see 7,000 by the end of the year?
It's possible, yeah.
So where do you go in this situation? What are you looking for when with the numbers like this?
Yeah, obviously the Mag 7 here are ruling the day. They're the ones in the spotlight. They're the ones with the big earnings announcements right now. And so information technology, communication services in the S&P 500, those are the two main tech sectors. But look, there are going to be some adjunct trends that we can play where the valuations aren't as high. For example, utilities. You mentioned data centers in your lead up to our interview. Mm-hmm. Data centers are going to be a foundational piece of the AI trend. And so the utilities are going to provide the power for that. And that utilities index right now is trading at prices more consistent with a 20 times earnings multiple rather than a 25 or a 26 multiple on the broader index as a whole. So there are ways we think to play this. One could also look at some energy sub-indices. For example, midstream would be one way to play. That would be natural gas. Some folks have talked about nuclear. We like also integrated oil because they are the companies that have the ability to provide natural gas as well as crude oil. So there are ways to play this AI trend, we think, without necessarily paying the top dollar. And that way, when the disappointments do materialize, and some of these headlines at some point will materialize disappointments, then when the market pulls back, one isn't losing as much as one would if one paid, let's say a 28 or a 32 or even a 35 multiple today.
And now, I just want to go back to the energy in that. A lot of people I feel are talking about nuclear, especially with the announcement today. Is it something that's kind of sexy, but it's still off in the future?
Well, it's developing quickly, and there are opportunities here, we think, and there are companies that an investor can invest in. I'm looking at things more from the top down. That's where my team is, and so what we're seeing it right now, midstream energy, we like that a lot. Integrated oil, we like that one a lot too. And then the overall utilities play, they're the ones that are going to be taking advantage of the nuclear power if and when that does arrive. And
riding that wave. Any other areas you're looking at right now?
We also like financials. Actually, financials are our most favorable sector right now. The yield curve has steepened. The Fed is cutting rates. We think there'll be more cuts tomorrow included, another one later this year, and maybe another couple next year. That should lower the deposit costs for banks, even as the 10-year and the 30-year maybe remain a little bit higher over time, and that expands that spread so that the deposit cost of the banks is falling while the lending costs, the lending rates of the banks are staying a little bit more elevated, and that spread favors the banks, we think, going forward. So yeah, financials most favorable. And look, at some point, AI is going to start to use more debt instead of equity, and the banks could figure to play a role in that too. So again, speaking about adjunct trends, that would be another one.
And I just want to just quickly touch on the Fed and the rate cuts. Pretty much everybody's saying it. I think it's at 98% the guess what it's going to be tomorrow, that it'll be a cut. Is everybody already factored that in? Is this something we don't even really need to pay attention to, do you think? Or what should we be looking for when it comes out?
Yeah, when it comes out, so the press conference will be important. How is the Fed treating the absence of employment data? Are they treating that as a sign to be concerned that the last look that we saw had a disappointing number of jobs being created? Or would the presumption be on the Fed's part that that's already or continuing to go on below the surface? If so, then yes, then probably the market responds positively, even though the rate cut itself is probably priced in.
Okay, let's get the crystal ball out. We got a little chart we're going to pull up that you put together for us, talking about some of your price targets for the middle of the year. 2026, you're saying S&P at 7,500 and oil 70, Brent at 75, gold still around 4,000, so virtually unchanged, kind of where we're at right now. And the federal funds target, you say 3 to 3.25%. Can you break that down a little bit? We're almost out of time, but can you break down some of those numbers and why you think we're going to be there?
Yeah, so these are year-end targets, and we think earnings will drive stock prices higher. We think the Fed will cut a couple of times more because the employment market will remain weak. And, gold is still in an uptrend, but we would be buying those pullbacks, definitely.
Okay. We appreciate you joining us, Paul. Thanks very much.
All right, thank you.
Paul Christopher is the head of global investment strategy at Wells Fargo Investment Institute.